If you're an entrepreneur, you've probably been told the same thing over and over. Just open a 401k, defer the taxes, worry about it later. But here's the uncomfortable truth most business owners never hear. Your 401k isn't fully yours. It's a joint account with the IRS. And the silent risk isn't market volatility. It's what happens when you finally want out and the tax bill shows up at the worst possible time. Stay with me, because in a few minutes, you'll see why this breaks exactly when entrepreneurs need flexibility the most. Hello, my name is Robert Balgac. I'm the founder and CEO of Black Swan Insurance Group. And since 2017, my team has helped 20,000 plus families design tax-free wealth strategies, and we have earned over 800 five-star Google reviews doing it. We don't sell products, we design structure, because design determines the outcome. So if you want to see how this applies to your situation, you can click on the link below and book a tax-free wealth strategy session with us. No pressure, just math. Now, let me show you how this plays out in real life. Meet Carlos. Carlos owns a regional construction company. Great margins, lumpy cash flow, and no employer 401k. Most of his wealth sits in business and a few rental properties. Carlos did what he was supposed to do. He opened a solo 401k, maxed it when cash flow allowed, deferred taxes, felt responsible. But every year he felt fragile. One slow quarter and contributions stopped. One market dip and his account dropped right after he needed liquidity. And there was a moment, quiet but revealing, when Carlos realized something was completely off. He was reviewing his numbers late one night, and the kitchen table was covered in invoices, and he caught himself thinking, if I couldn't work for a year, what happens? That was his formative money image. Not poverty, not recklessness, just the realization that permission-based money is fragile money. And that's where the real lesson begins. The 401k illusion. Here's the first thing most entrepreneurs miss. A 401k doesn't eliminate taxes. It defers them into an unknown future. The IRS is your silent business partner. They don't care how volatile your income was, how hard you work, or when you want to slow down. They care about one thing: when distributions begin. Required minimum distributions, also known as RMDs, force income when you may not want it. Tax rates are unknown, and history suggests they don't tend to trend down. And this wasn't a loophole. It was a rule book. And here's where most high earners get burned. They assume they'll be in a lower bracket later. But when deductions disappear, business income tapers unpredictably, and RMDs stack up on top, often the opposite happens. In a minute, you'll see why this becomes a timing problem, not just a tax problem. Let's put some real numbers on this. So Carlos was contributing $1,000 per month, $12,000 per year into his solo 401k. Over the next 20 years, assuming a reasonable stock market return of 10%, that account is projected to have roughly $1,050,000. Looks solid until reality shows up. Now assume something completely normal. Carlos retires into a 20% market correction. So that $1,050,000 instantly becomes about $840,000. Now the IRS enters the conversation. At a conservative 30% combined tax rate, a 7% withdrawal gives him $58,800 gross, but only $41,160 net. And that's before sequence risk, because this isn't about beating the market, it's about surviving it. So if Carlos needs income after the market drop, he's selling assets at the worst possible time. That's timing risk layered on top of tax drag. Structure beats speculation, and this is where the comparison starts to matter. Now contrast that with a properly structured max-funded IUL. Same $1,000 a month, same 20 years, but instead of deferring taxes, Carlos pays tax on a seat. So he puts in after-tax money into the IUL, which helps him harvest growth tax-free. Under IRS Section 7702, his cash value grows tax-deferred. Access is through policy loans, when structured correctly, not taxable income. This only works if the policy is designed to avoid max status under Section 7702A, overfunded too fast, or structure it wrong, and the tax advantages disappear. That's why design determines the outcome. When done correctly, there will be no RMDs, no age restrictions, no asking permission. And this isn't about magic. It's math, compliance, and structure. With conservative assumptions of 6.81 indexing returns, Carlos' IUL is projected to have around $599,000 in cash value at retirement. Smaller than the 401k on paper, but here's the difference. Liquidity is oxygen. The cash is accessible without triggering taxable income, without selling assets after a market drop, and without asking permission. Same money, same effort, completely different outcome. But this story isn't finished yet. 2 years into setting up his policy, something happened. Carlos injured his shoulder on a job site. Nothing catastrophic, but enough that he couldn't work full-time for 6 months. Project slowed, revenue dipped, and suddenly, retirement planning became income continuity. His 401k, untouchable without penalties, loan rules, and repayment pressure. His brokerage account, down with the market that quarter. But the IUL, he was able to access $20,000 through a policy loan, tax-free. No applications, no credit check, no IRS forms. And his remaining cash value kept compounding. That's when he realized his wealth wasn't just about retirement income. It was about control during disruption. These living benefits aren't just a rider, they're the point when designed correct. Here's the part most people get wrong. Costs don't kill IULs. Bad design does. Same policy, same carrier, completely different outcome. If the death benefit is oversized, too big, the insurance costs eat the cash value. If the funding is too slow, compounding never gets traction. If loans aren't engineered properly, lapse risk creeps in. This is not set it and forget it. This is set it and steward it. When designed for entrepreneurs with irregular income, liquidity needs, and exit uncertainty, an IUL becomes a structural layer, not an added burden. Your business builds income, your IUL builds freedom. Now, let's resolve the numbers. So let's read the table left to the right. On 401k side, Carlos retires into a market correction, starting balance $840,000, 7% withdrawal, $58,800, taxes around 30%. So what does he actually keep? Around $41,160 per year. And that income isn't permanent. At that rate, the account depletes in roughly 18 years, which means by his early 80s, the money's gone. At age 85, his legacy is zero. Now the max funded IUL, starting cash value, $599,000, income, $55,646 per year, taxes, zero. Lower starting balance, higher spendable income. Why? Because there's no tax track. And the income projects beyond age 90. And at age 85, there is still a $365,000 tax-free legacy for his family. Same contribution, same effort, completely different ending. Carlos didn't beat the market. He beat tax track, volatility, and timing risk. Without triggering taxable income, without selling assets after a market drop, without asking permission. At age 85, one strategy leaves nothing. The other one leaves $365,000 tax-free. That's not an opinion. That's the structure. And that structure replaced hope. So if you're an entrepreneur relying solely on 401k, you're betting that taxes cooperate, markets behave, and life stays predictable. That's not a plan. That's a gamble. If you want to see how this structure could possibly fit into your own blueprint, the next step is simple. Click on the link below and book a tax-free wealth strategy session with us. We're going to go and build a plan around your numbers and your goals. And remember, it's not what you earn, it's what you keep. Enjoy the ride.